Today we're going to be talking about the risk transfer and insurance issues relating to contractors and how they affect businesses and construction companies and subcontractors. So let's get into risk transfer. So the idea here is that you've got a contractor or a property owner who has inherent risk. So they may hire a subcontractor or have a commercial tenant. And they both have their respective insurance policies, and we're particularly talking about liability insurance here. But the idea here is that the contractor or the property owner has inherent risk for work done by the subcontractor, or if they're a tenant, customers or whatnot to come onto the property. And so the concept of risk transfer is to take that risk that's inherent with the upper tier and transfer it to the lower tier. You really want to tap into the subcontractor's insurance policy. So here's our builder again, and this certificate of insurance is representative of the builder's insurance, their own insurance. And the idea is if you've got this inherent risk with all these trade contractors, you want to be able to tap into their insurance from all these different trades on the project rather than just tapping into your own insurance. And there's a unique way to do this, or an important way to do this in order to accomplish this. So we're going to talk about that. So we've got contracts and we've got insurance. There's integration rather between the contract and the insurance, and so this is going to make more sense in a minute. But basically, the idea is there can be language contained in a contract, and in this case, we're talking about a subcontractor agreement between the upper tier and the lower tier, and that contract binds or can bind the insurance company of the subcontractor or lower tier contractor if it's written properly and executed, of course. So we've got hold harmless indemnification language. Should be state-specific language because each state has their own indemnification requirements, prohibitions, I guess you'd say. The contract should be in place before the work actually starts, because you cannot retroactively bind somebody generally, or particularly an insurance company. The contract should contain specific insurance requirements dealing with the types of coverage, the limits of coverage, different endorsements. I'm talking about like additional insured, waiver of subrogation, primary non-contributory, and also prohibited exclusions. So you're limiting the subcontractor as to what exclusions their liability insurance policy can contain. Then over on the insurance side, for the sub, you've got their liability insurance. Of course, we all know that we need to get a certificate of insurance, but for the most part, certificates of insurance do not hold the value that most people put in them. But I will talk more about that and show you what I'm talking about, because it's a very limited amount of information. You should also be obtaining separate sheets of paper along with that certificate of insurance. These are called endorsements, which I'll get into in a bit. One thing I like to bring up to people is even if you're getting the contract with your subcontractor, it has all the right language in it, you're getting the certificate of insurance, all the right endorsements. If that subcontractor doesn't have coverage for the scope of work performed, none of this other stuff matters because they're not actually covered unless the subcontractor has deep pockets, and typically the subcontractors do not have deep pockets. And so really what we're trying to do is tap into, as I mentioned earlier, tap into the insurance company and their deep pockets, the insurance company of the sub. So if something goes wrong, we want to be able to tap into the insurance company of the subcontractor. But if there exclusions exist that take away coverage for their scope of work that they're doing on your behalf, none of the rest of this stuff will matter. So that's a concern because certificates of insurance do not mention what exclusions are contained in the subcontractor's insurance policy. We recommend that you require auto liability coverage of your sub because they could be bringing vehicles onto your job site. This goes, by the way, not just for subcontractors but also suppliers. And additional insured and waiver of subrogation endorsements that should go along with that. Workers' comp for their workers, for their employees, but also you should get what's called a waiver of subrogation endorsement that waives the rights of the insurance company of the sub, the workers' comp insurer, from coming after you, the upper tier, in the event that an employee is injured on the job. They can try and go after the upper tier or the owner for workplace injury, illness, or death that the work comp carrier is liable to pay out on. And so it's important to retain all this information for a period of time, which we'll get into, which is probably much longer than most understand. So you've got the kind of what I say the old-fashioned way, which is just getting a certificate of insurance versus getting the certificates, all the right endorsements, subcontract agreements, and understanding or knowing what exclusions are contained in the subcontractor's insurance policy. And without getting a copy of all your sub's insurance policies, reading through every single one of their policy languages and exclusions, an upper tier would never know what exclusions are contained in the policy. Now, we will talk about a solution to help manage that. So here's just an example of construction defect litigation scenario. These pictures diagram different areas where mostly there's water intrusion on the exterior of a building, of a structure. Also, oftentimes we see structural concerns. And so these are issues relating to construction defect. In fact, this is the actual lawsuit in this case, and as you can see, what we're talking about, talks about in particular the installation of roofs, weather resistance of the entire building envelope, surface drainage concerns, water management concerns, window and door assemblies, stucco cladding, stone veneer, deck assemblies, roof assemblies, structural concerns, and water leakage and moisture accumulation. This is what we're talking about with construction defect lawsuits. Here's some common problems which we'll talk about: statute of repose limitations, particularly for contractors, exclusions and limitations, the certificate of insurance requester is unaware of, breach of contract for failing to transfer risk, increased premiums when certificates are missing. Most contractors understand that. That's a pretty basic one. Records retention, as we mentioned, the inability to tender defense due to missing subcontractor or tenant insurance information, subcontractor independent contractor warranty provisions. So we've got risk category here of question that we've got: construction defect litigation. What is the statute of repose or limitations in the state of Utah? 9 years, this is the answer, 9 years plus 2 years if discovery occurs in the 8th or 9th years, for a total of 11 years. In the state of Utah, a contractor or subcontractor can get sued for up to 11 years. In most states it's around 10 years, but in Utah it's 11 years. Some states it's as low as 6, and some states it's unlimited. And the statute of repose is actually a good thing, because without the statute of repose there's no limit. In other words, it's good for the contractor, because without the statute there's no limit, and an owner could sue a contractor indefinitely. So a contractor may not agree with or like the 11-year term, but it's better than not having any at all. So here's the actual statute of repose. You can look this up on the State of Utah's website, and it talks about how a contract statute is: an action by or against a provider based on contract or warranty shall be commenced within 6 years of the date of completion of the improvement. So there's a 6-year statute, contractual, and then notwithstanding subsection 3B, an action may not be commenced against a provider more than 9 years after the completion of the improvement or abandonment of construction. In the event the cause or action is discovered or discoverable in the 8th or 9th year of the 9-year period, the injured person shall have 2 additional years from the date to commence an action. So again, we're talking about 11 years, up to 11 years. In some states I mentioned as low as 6. So here's some examples of some exclusions. I'm not going to go through each one of these on this page, but there's more than this, but this is just kind of a partial list. And so this is the way that insurance companies are dealing with all of the billions of dollars that have been paid out in construction defect lawsuits over the years. One of the ways that they're dealing with this is they're putting more and more exclusions. Now, exclusions may or may not be a big deal. If the if the insurance company is excluding something that's not in your scope of work, no big deal. However, if they are, then it can be a big deal. And just because these exclusions exist does not mean that they're contained in every single policy. So you would need to understand what's actually contained in your policy to know if that one of these exclusions that's applicable to your scope of work is contained. Subsequently, these can be, you can negotiate sometimes some of these exclusions out. Also, you may be able to find an insurance company who provides coverage without this exclusion that's contained that ties back to your scope of work. So I'm going to talk about some real-life examples. So in this real case, the general contractor was building a 4-story apartment building, 4 stories. The roofer had a limitation in their insurance policy that limited them to 3 stories or 36 feet. So there was no coverage for bodily injury or property damage at all. 0 coverage on any projects above 3 stories. So in this case, the general contractor would have never known under the normal approach of just getting a certificate of insurance, and would have never known to address this. And I'm not even sure that the roofing contractor knew that they had this limitation in their policy. And this is a major limitation, because this is the difference between I mean, basically they didn't have any coverage at all. When this was discovered, and I'll talk about a solution on how this was discovered later, but this was discovered and the insurance agent of the subcontractor was able to go back to the insurance company and negotiate raising that limit up to 4 stories or 48 feet. And look at this, there was no change in premium. So this was just kind of an I dot and T cross type situation, but without knowing it, there was no one knew to do anything about it. So again, this is the difference between having zero coverage or having coverage, is understanding what's in that policy. Here's another example of an exclusion. This is a townhome or multifamily exclusion. This was a plumbing contractor who was working on a townhouse project. There was a claim. The claim was denied, and it was a townhouse project as a group of dwelling. In the policy, this was the language in the subcontractor's policy, the plumber's policy. It says townhouse projects is a group of dwelling units, normally having 2 but sometimes 3 stories. Each unit usually connected to a similar structure by common wall. So in this case, the claim involved alleged construction defects arising out of the development and construction of a townhouse project pursuant to this exclusion. There's no coverage under the above caption policy for your work or products that are part of or incorporated into a townhouse project. Now, if you're the general contractor, wouldn't you want to know that your subcontractor has zero coverage on that project before they start work? I would think you would answer that question yes. So this is a major problem, major concern, because again, the upper tier contractor is trying to tap into as many subcontractors' insurance policies as they can, because if the sub is at fault, in theory, the sub should be responsible for taking care of that issue, or their insurance company. And so that's the idea behind risk transfer. Well, you can transfer risk all you want, but if it's not done, if they don't have coverage, that's a problem. Now here's a common exclusion. This is a subsidence exclusion. So if an excavator, landscaper, concrete, oftentimes we even see general contractors with this exclusion these days. And it basically says that the insurance will not apply to injury or loss expense, so property damage based upon rising out of subsidence of land or any earth movement, including but not limited to earthquake, landslide, mudslide, earth sinking, rising or shifting, regardless of whether such subsidence or earth movement caused, aggravated, or contributed concurrently or in any sequence to any injury or loss. So the point is that if you touch earth and you have this, and there's any subsequent earth movement, even settling, you could have some major things like landslides, which certainly have happened in Utah and in many other states, but also settling and cracking issues. And in those cases, there would be no liability coverage with that subsidence exclusion. Here's another exclusion. This actually has, it's the collapse, underground, and explosions exclusion. So this insurance does not apply to property damage for explosion, collapse, or underground property damage hazard. And this talks about the collapse of a hazard, explosion. I'd like to use an example of a painting contractor I know of who had a propane heater inside the structure that they were painting, and as they were spraying, that propane heater ignited and exploded. And with this exclusion in the policy, there would be no coverage. But then it talks about grading the land, excavating, backfilling, tunneling, pile driving, cofferdam work. This has to do with the underground part of this exclusion. So in the underground part of this exclusion, it's going to exclude if the contractor dug into a wire or conduit, pipes, mains, sewer mains, water mains, tanks, tunnels, or similar property. In fact, I saw an excavator's policy once who had both the underground exclusion and the subsidence exclusion. And I looked at him and I said, what are you covered for here? And basically the only thing I could think of is if he ran somebody over in his backhoe. But as far as a construction defect issue, anything to do with the dirt, he had zero coverage. So you got to really watch out for what's going on here. Now, let's talk about the year work exclusion. The year work exclusion, insurance was never designed to be a warranty. So in this example, I'm going to talk about a very expensive retaining wall. Say it's a $100,000 retaining wall, and it's built by, let's say, an excavator. The wall fails, and as a result, there's property damage or bodily injury with earth moving in. And insurance, it would cover the resulting damage. So it wouldn't cover to rebuild the wall, because insurance was not, liability insurance was not designed to warrant your work product. It is designed to cover resulting damage. So in this case, the coverage would have not paid for the rebuilding of the wall. And if the excavator had a subsidence exclusion, it wouldn't even cover for the resulting damage either. So that can be a problem. Now, let's use that same example of the wall and go to the exclusion called what I call the subcontractor exclusion, or excluding the work of the subcontractor. In this exclusion, this is for anyone who's an upper tier hiring a lower tier. If your insurance, as the upper tier, has this language in it, then it will not cover for the rebuilding of the wall. So normally the subs policy would not cover for rebuilding of the wall, but maybe the generals would. Subs would cover the resulting damage, the general would cover, insurance would cover for the rebuilding of the wall. But because the general in this case had this exclusion, they would not have any coverage for the property damage to work done by a subcontractor, because it considers your work to not only include your own work, but also the subcontractor's work. Okay, moving on. There's multiple residential exclusions out there. So you have to really understand, if you're doing residential work, if your policy contains one of these. These could include just an outright new residential construction, regardless of the type of project. In this case, it talks about a condominium development, townhouse development, residential housing development, planned unit development, or mixed-use development. So that encompasses quite a bit. So you could have a tract housing exclusion specifically, or you could have a multifamily exclusion, or you could have just a condo exclusion, or just a townhouse exclusion, or just a apartment exclusion. So you really have to understand the residential exclusions, and these are popping up all over the place for both subs and generals. Okay, so let's talk about completed operations exposure for a moment. I'm going to give you an example of a plumbing contractor that his policy is written on an occurrence basis, not a claims-made basis. If you have a claims-made basis policy, you might want to consider changing that to an occurrence-based policy. Those claims-made policies require tail coverage, and there's all kinds of issues relating to a claims-made. But a typical occurrence-based policy, which most policies are written on for contractors. In this case, the policy was written from January of 05 to January of 06. Policy was renewed for 2 consecutive years with the concurrent policy beginning 07 to 08. In September 15th of 05, the contractor makes a mistake installing a new plumbing unit in the home. In December of 06, the plumbing system malfunctions as a result of the mistake, causing the property damage to the home. The claim, however, is not made until the next month later, in January, and the claim would be covered by the 06 policy regardless of the fact that the negligent act occurred in 05 and the claim was made in 07. I say it would be covered, the resulting damage would be covered, but not the work product itself, meaning changing out the unit. Now, again, assuming they don't have some kind of exclusion like a residential exclusion that may prohibit there to be coverage. So let's look at it this way. So the policy, when he installed the project, was in this policy term. The occurrence, or the property damage, occurred in the second policy term, and the claim was made in this policy term. So it's not when the claim was made that determines it under an occurrence-based policy, and it's not when the product was installed incorrectly that covers it. It's when the damage occurs, or the occurrence. That's the definition of an occurrence. So it would be this insurance policy, this insurance company, and this is why contractors wonder why insurance companies want to know what you've done over the last 10 years in work, and it's because they could get brought into something where the damage occurs from something you've done many, many years ago. So you really need to watch out for policies because they could change from year to year. So you could have a policy that was perfectly fine without any bad exclusions in this year, and then it renews, or you switch to another insurance company and they have some type of an exclusion that, for example, the prior work exclusion, which I think is what we're going to talk about next. So yes, so the prior work. If you have a prior work exclusion, this is a very bad exclusion, because it excludes bodily injury, property damage arising out of or resulting from or caused by, contributed to, or in any way related in whole or in part to your work that was completed or abandoned by the insured prior to the inception date of the policy set forth in the declaration. So let's say you had a policy here and a policy previous years to this one that did not have the prior work exclusion, but when you purchased this policy it had a prior work exclusion, and maybe you thought you might save some money and you purchased this policy not knowing that what you were purchasing, or the agent maybe not have even known what they were selling you. And so what could happen is you have the mistake that happens back here. This insurance company, who has a duty to defend you under normal circumstances, because of that exclusion would have no duty to defend you, and this is when the occurrence takes place. So they have no duty to defend you, and they have no responsibility to pay for that occurrence or that loss that has taken place. Now, some could argue that, hey, well, maybe this other insurance company might get brought into it, and they may be forced into paying out in some as a percentage of the negligence that they may have had. So you really want to make sure to not get a policy that has a prior work exclusion, if at all possible. We're going to talk about next exclusion is injury to subcontractor and subrogation. So do you, as the upper tier contractor, have liability coverage in the event of a lawsuit from a sub's employee, or is this coverage excluded in your policy? So, for example, the sub's employee gets injured on the job. They can not only make a claim on their workers' comp policy, the employer's work comp policy, but they can sue the upper tier or the owner of the project. And so the question is does your policy have a subcontractor injury exclusion, which I'll show you in a minute? Do you, as the upper tier, have a waiver of subrogation in your favor from the lower tier's workers' comp company? So again, there's two scenarios playing out here. One is the employee gets injured, sues you, and you may not have coverage on your policy for that lawsuit. Or two, they make a claim on their workers' comp policy, and the work comp company comes back and sues the general or the owner, claiming some negligence on the part of the general or the owner. So that's a key thing to have, is that waiver of subrogation on the workers' comp. And then, of course, do you have a written indemnification agreement? But that goes into the next discussion here. Well, let me show you this first of all. This is the exclusion that excludes injury to volunteer, temporary workers, volunteer casual workers, or independent contractors. So in this scenario, if the upper tier were sued, or the owner, right here, the independent contractor hired directly or indirectly by you or on your behalf. So there would be no coverage for bodily injury from a suit that occurs from an employee of an independent contractor who was hired on your behalf. So this is one that you want to try and negotiate out if you're an upper tier contractor. Oh, there's the employee of the independent contractor. Now, here's one that is becoming more and more rampant, which is the third-party action over lawsuits. And this is the scenario where the upper tier does have a hold harmless indemnification agreement. And just to be clear, what a hold harmless indemnification agreement is, the lower tier is agreeing to hold the upper tier harmless and agreeing to indemnify them or make them whole for something that occurs where the upper tier is brought into it. If the upper tier has a hold harmless indemnification agreement, then and the lower tier's employee gets injured or killed and they sue the upper tier, if the upper tier has this hold harmless indemnification, it pushes it back down to the subcontractor. So it's this action over. Now, in some cases that might be covered by the Part B of the workers' comp policy of the subcontractor, the employer, and that's called employer liability coverage. And we generally recommend that a subcontractor or general require of his subcontractor to have at least $1 million limit on that employer liability, because even if, let's say, they only had a $100,000 limit and that was pushed back down to the sub's insurance pays out $100,000 and the lawsuit's for the settlement's for a higher amount, the sub ends up closing their doors, then it still falls back on the upper tier contractor in that case, because if the sub has closed their doors, there's no indemnification agreement in place really at that point, because there's no one to go after, and then it could result to come back on the upper tier contractor. So we highly recommend to upper tiers to require of their lower tiers $1 million limit on the work comp on employer liability. And secondly, the lower tier subcontractor could have an exclusion in their policy where their general liability policy does not consider the hold harmless indemnification agreement as an insured contract between them and the upper tier. And so the general liability could cover the employer if entered into a subcontract agreement unless 9F insured contract is taken out of the subcontractor's liability policy. This is referred to oftentimes as a CG 2139 form or a similar limitation depending upon the insurance company. So here's what that says. It says that the contractual liability normally is an exclusion and does not provide coverage in the policy, except for there can be some contracts that are considered insured contracts. So contractual liability is normally excluded. Exceptions include liability in absence of a contract, an insured contract, and some other ones which we won't get into. But an insured contract, which is this 9F that I was referring to, contains different types of contracts: sidetrack agreement, easement, obligation, but the key elevator maintenance. But the one that I'm referring to, which sometimes is removed from the insurance policy, is that part of any other contract or agreement pertaining to your business, including an indemnification of a municipality in connection with work performed for a municipality, under which you assume the tort liability of another party. So this would be a scenario where it's an action over lawsuit, and your policy now does, as the lower tier, no longer covers for that type of a situation. And the upper tiers need to be concerned about this as well, because again, if the insurance, the deep pocket of an insurance company isn't there, now you're solely relying upon the pockets of the subcontractor, which may not be very deep. And if they're not deep, then it comes back to you, even if you've gotten that hold harmless indemnification agreement. So subs, you should really watch out for this exclusion, and generals, you should try to make sure you don't hire subs that have this exclusion in their policies. And the key there on any of these exclusions is knowing if they exist in the subcontractor's policy. And most, in fact, I've never met a single contractor, training tens of thousands of them over the years, who is actually getting copies of their full copies of their subcontractor's insurance policies, reading through them in detail, understanding all the provisions, exclusions, limitations, and to determine if that sub is truly covered on their project, because the certificate of insurance makes no mention of what exclusions are contained in the policy. In fact, it tells you that there are exclusions, it just doesn't tell you what those exclusions are.
Upper tiers, insurance company, and sublimits. A recipe for disaster. Some insurance companies are now imposing coverage reductions, sublimits, on upper-tier contractors whose subcontractors' insurance policies contain third-party action over exclusions or limitations. So how this plays out is if the upper-tier general contractor has $1 million liability limit on their own liability policy, plus a subcontractor who has a policy that contains a third-party action over exclusion or limitation, the result is there are insurance companies now who are reducing the liability coverage limit on the upper tiers or general contractor's policy from $1 million down to a $250,000 sublimit. This is of great concern and is all the more reason why an upper tier contractor would want to use a system like GotMyCerts.com as a mechanism to uncover these types of exclusions in the subcontractor's insurance policies.
Okay, so let's talk about contracts for a minute. So this is an example of a contract. This is just a sample. This is don't rely upon this. This is just for demo purposes here. This is a contract between an owner and an upper tier, a GC. Okay, so oftentimes the owner, and this usually happens in a commercial project. Oftentimes residential projects, they don't. The owners may not be as sophisticated on this, but this is, let's say this is a commercial project, and the owner contains language in the contract between them and the GC that holds harmless and indemnifies the owner for problems that occur from the GC's fault of the GC. Oftentimes they require different types of insurance coverage, liability, work comp, auto, umbrella maybe even. The owner wants to be listed as an additional insured and may even want other endorsements on there like waiver of subrogation. Oftentimes the owner in these contracts, if they're written well for the owner, have obligations for the upper tier contractor to transfer risk downstream to any lower tier contractor. Now, as the subcontract agreement between the upper tier and lower tier, here's the question. Is the upper tier in breach of contract? What am I talking about? I'm talking about the contract that the upper tier signed with the owner because of these obligations to transfer risk downstream. So the question is the upper tier properly transferring the risk and protecting the owner? In this case is the upper tier. The owner is the highest upper tier in this case. Is that contract between the general upper tier and the sub lower tier protecting the owner equally as does the contract between the owner and the GC? Does it contain the right hold harmless indemnification agreement that's state specific, legal in that state? Does it have all the right coverages, all the right required endorsements, the risk transfer obligations to transfer downstream to even lower tier? So you've got a first tier sub who could hire a second tier sub who could frankly hire a third or fourth tier sub. So again, you want to transfer the risk all the way downstream. And you do that through the contract, and you do that through the insurance. And then finally, the flow down clause, there's oftentimes language in the contract between the subcontractor and the GC, so the upper tier and lower tier, that binds this lower tier to the prime contract as well. So as a word to the wise to the lower tier contractor, if you're signing a contract that binds you to a secondary contract, the prime contract, you might want to get a copy of that prime contract so you know what you're agreeing to. You should also include some exclusions of insurance coverage in the actual subcontract agreement. But that doesn't do you, it does you some good because you're disclosing to the sub, hey, you can't have this exclusion, that exclusion in your insurance. But at the end of the day, a contract, if that sub's out of business, they don't have the deep pockets, you really need to have that language in the contract, but you also need to follow through and make sure you're finding out what exclusions are contained in their actual policy. Okay, here's an example of a large, in Utah, large multifamily contractor. Now, one thing that's interesting that I like about their contract, which we usually recommend, is that the general liability shall include coverage for itself and each additional insured for the period of the statute of repose. Sometimes we'll see this for 1 year through the end of the project, for 1 year, for 2 years, for 5 years. But why would you only want protection for 1 year or 2 years if the statute of repose is 11 years? Don't you want to be additionally insured on your subcontractor's insurance through that full 11-year period? And so the contract should contain language in there, but also from a practical standpoint, you should also be getting certificates and endorsements all the way through that full statute of repose from that subcontractor. And if you're not doing that, even though they've agreed in contract, they may not actually be following through, especially if they're not doing work for you anymore as the upper tier. In this example, they listed some prohibited exclusions. They listed residential or multifamily. If you have that, if you're doing that type of work, you can't have that exclusion in your policy. They listed synthetic stucco for someone that might be doing synthetic stucco. Asbestos and mold here for those that might be doing remediation. They're requiring auto liability. So this is a pretty well written contract, but I noticed they didn't say anything about soil subsidence, or there's a whole host of other exclusions that they did not list in here. Here's that language of an owner who may list out that if you engage a subcontractor to help perform the company, the company being the GC, obligations under this agreement, the company first must obtain the owner's written approval and then enter into a written contract with the subcontractor that contains terms at least as protective of the owner as the terms of this agreement. So you got to watch out for that. If you're the upper tier being hired by an owner, if they have language in their contract obligating you to make sure your subs are protecting them as equally as does the contract between you and them, you need to make sure you do that, or else you're in breach of contract. So here's just an example of flow down clause. This is from an upper tier perspective. The contractor or subcontractor shall mutually be bound by the terms of this agreement, and to the extent that the provisions of, and this happens to be language out of the AIA document, apply to this agreement pursuant to section 1.2, and provisions of the prime contract apply to the work of the subcontractor. Contractor shall assume toward the subcontractor all obligations and responsibilities the owner under such documents assume toward the contractor, and the subcontractor shall assume toward the contractor all obligations and responsibility which the contractor under such document assume toward the owner and architect. So be aware of this from an upper tier standpoint. From a lower tier standpoint, you need to be aware of flow down clause. Again, by not reviewing the general contract, subcontractor through a flow down clause may unwittingly agree to terms that arguably have nothing to do with its work. Terms that an unsuspecting contractor, and this is a subcontractor here that's talking to, may be agreeing to a flow down clause, include termination clauses, claim processing clauses, then indemnification clauses, and dispute resolution clauses. So again, before signing a subcontract, make sure you understand and see that, copy that prime contract. So here's an example of a certificate of insurance. Now we all know that for insurance audit purpose, when you're audited from an insurance company, they're going to want to see if you've hired any subs and if they have insurance. Now, more and more insurance companies are going much deeper than just a certificate and asking for much more than that these days, and I suspect that this is going to continue to get more and more detailed as construction defect litigation continues to worsen. But everybody, or you should know, that you need to get a copy of the liability and workers' comp at a minimum from all your subcontractors. And failure to do so could equal increased premiums. And what I was saying before is that this just isn't good enough anymore. You have to get a certificate, but you've got to get much, much more to do this correctly. Now, here's one of the issues you need to be concerned about. This is called the subcontractor warranty provision. This is contained in the upper tier contractor, and an upper tier could be a subcontractor or a general contractor. So you can have, and insurance companies, in addition to exclusions, this is one more area where they're coming out with new provisions and policies as a way to reduce the insurance company's exposure. So what they'll do is they'll say, hey, upper tier, if you haven't properly transferred risk, and they define that, I'll show you what they do with that in a minute, we're going to increase your deductible from 0 to anywhere from $10,000 to $50,000 in the event of a loss, or $1,000 to $10,000 or $50,000. So it's a substantial. In fact, I just worked with a contractor where his deductible went from a $5,000 deductible to a $10,000 because he wasn't properly transferring risk. You could see significantly increased premiums. I was talking to another general contractor in one of my courses, and he said, yes, this exact thing happened to me. I had gotten certificates from all of my subcontractors. The auditor came in. He's never asked for this before. He wanted to see the signed subcontract agreements that contain the hold harmless indemnification language and all the right insurance language in the contract. Well, I wasn't having anyone sign that. Well, he said, I didn't know that I was supposed to be doing that. And so he received a bill for over $60,000 increased premium, not because he was missing certificates, but because he wasn't transferring risk properly. And contractors are going to see this happen more and more often as insurance companies decide to put this subcontractor warranty language in the policy or obligate the contractor via the insurance application that the contractor signs when they're signing it for insurance or renewing insurance, that obligates them to do the risk transfer process properly. We've seen cases where insurance companies will decrease coverage. They may decrease coverage down to a sub-limit. I've seen $50,000, so you normally buy $1 million limit, but if you haven't risk transferred and there's a loss, they may take that $1 million coverage and decrease it down to $50,000. There's an insurance company now who, if the subcontractor of the general has a exclusion, the third-party action or overaction exclusion in their policy, they're putting in a sub-limit down to $250,000. So if you as the upper tier hire a sub who has that 9F exclusion in their policy or equivalent, then and there's no action over protection for the subcontractor, then the general contractor's insurance company or the upper tier contractor's insurance company could be liable to pay out on a loss, and in this case they're putting in a sub-limit into their policy, taking it down from $1 million to $250,000 in coverage. So insurance companies are getting tired of paying out on all these construction defect claims, and so they're putting in all these provisions. There's one in here that completely eliminates coverage 100%, and this is the one I'm going to show you. Now, for any insurance agents that may be watching this, I believe this exposure adds significant errors and omissions to the agent who sold the policy, because if the insurance agent failed to notify the contractor, the upper tier, whether it's a GC or a sub, then it adds errors and omissions exposure to the insurance agent. So here's an example of a form from an actual insurance company. They require a formal written contract with the subcontractor, have to have the $1 million, $2 million limits of the sub. They have to have hold harmless indemnification language contained in the subcontract agreement. They have to additionally insure the upper tier contractor, and they have to use specific versions of the additional insured. In this case, the 2010-704 edition and the 2037. So one is for ongoing operations, the other one is for completed operations, and they want the July of 2004 edition or their equivalent. And there were later editions of the additional insured forms in 2013. This particular insurance company does not consider the 2013 versions of the additional insured to be equivalent. So if the upper tier contractor obtains additional insured, but it's the 2013 version and they have this provision in their policy, there is no coverage. Insurance will not apply to any loss or claim unless all the above conditions have been met. So basically you've gone from $1 million, $2 million limit down to 0. Because of your lack of proper risk transfer, according to the terms and conditions of this independent contractor warranty. Okay, here's the next category, risk transfer. The question is, what is a great tool to transfer risk to a lower tier subcontractor who did the work? Hold harmless indemnification agreement. So indemnification language, this is just some example of language. I'm not recommending that you use this necessarily, but you need to understand that this is good safe harbor language to the fullest extent permitted by law, because some states have anti-indemnification language in their state statute, like Utah does, and so you need to be aware of what that state requirement is. So your contracts really need to be state specific. In fact, here is Utah's, what's often referred to as the anti-indemnification clause. This is the state law, and it basically says if you're a contractor, a GC or a sub, that an upper tier cannot, by statute, can't require the lower tier to indemnify the upper tier for damages that were caused by the upper tier. The state of Utah says you cannot, as an upper tier, require a lower tier to indemnify you for things that you do that are your fault as the upper tier. And so certain states have different provisions in that, so you want to make sure your contract is applicable to the state you're doing work in, so it's not thrown out in court. It was interesting because in this provision it does allow the indemnification to the owner. Even if the owner is negligent, the owner could be indemnified, but that's the owner, that's not the contractor. Alright, so there's multiple versions of the additional insured. Most people don't use this. Was the broadest version, the CG 2010-11 of 1985 version, which protected both ongoing, so while the subcontractor's on the project or until the project's been put to its intended use, and also completed operations, which is after the project is done or the sub is done or it's been put to its intended use. It's defined differently depending upon the version of the additional insured that's used. So you want to make sure that you're getting both an ongoing and completed operation version of the additional insured. Now, one thing I want to mention is there are blanket additional insured versions, but there's some positives and negatives to the blanket. The negative is it's almost always subject to, and here's an example, it may only cover ongoing operations and not completed operations. Let's give you an example. A subcontractor puts up a panel on the wall. The panel falls off and hits somebody in the head while the contractor is still doing work on that project. Well, that would fall under the ongoing operations exposure. Let's say the subcontractor puts the panel on the wall and leaves the project, and the project now is put to its intended use. 6 months goes by and the panel falls off the wall and comes crashing down on an employee at the company or on a customer. That would fall under completed operations coverage. So you want to be careful, because a lot of times insurance companies will maybe only want to do or automatically do in the automatic the ongoing operations coverage. They also almost always require a contract with the proper additional insured language included as part of the requirement, meaning will automatically additionally insure anyone you're doing work for. So this is contained in the subcontractor's policy, the lower tiers policy. It says will automatically additionally insure anyone you're doing work for, subject to the terms and conditions of the contract. So for those people you've agreed in writing in a contract that such person or organization be added as an additional insured. So if the contract doesn't exist, it wasn't signed, wasn't written properly, even if you get a additional insured certificate of insurance, which I'll show you in a minute, you are not actually an additional insured. So you have to have that contract. You also probably want to be additionally insured from a completed operations standpoint. There are some insurance companies that do completed operations on a blanket basis, which again is subject to the terms and conditions of the contract. Or you can require, say, this version, the 2037-704 version, where you're specifically listed or supposed to be specifically listed. So if you get this endorsement and your name is not on there, if you're the upper tier, or the location is not on there, then you're not an additional insured. So it could say your name and the specific location, or it could say for anyone you're doing work for or have a contract with. Sometimes the insurance company will put that language in here under this additional insured organization box, and maybe they'll do all work performed in this box. So that's more of a broad blanketed type of endorsement. But again, this is something you want to make sure you're getting, because if your name is not in here or doesn't identify the work that they're doing, you're not actually an additional insured. And again, as I mentioned before, you really, as a best practice, should be requiring this through the Statute of Repose. And the positive, possibly, of doing a blanket additional insured, depending upon the language of the blanket additional insured for both ongoing and completed operations, is if you have a subcontract agreement that does obligate them to additionally insure you through the Statute of Repose, and you fail to continue to get the endorsement every year because that contractor may no longer be doing work for you, that additional insured automatic basis may, it's a big may cover you if that contract is in place and stated that they had to cover you through the Statute of Repose. It just depends on the insurance company that the sub is insured with and the language of the additional insured endorsement. If there's some kind of length of limitation on the length of time that they'll additionally insure you, even if it's subject to the language of the subcontract agreement, there may be a limit on the length of time. So there's a lot of variables here. Honestly, the best way would be, best practice would be require the additional insured for both ongoing and completed operations in the contract, and obtain that protection, those endorsements, through the statute of repose from your subcontractor. Primary non-contributory, this is another document, another form that causes the insurance of the sub to be primary non-contributing. It's about the priority of insurance coverage, which policy will respond as primary insurance and which policy will respond as excess. In other words, whose policy will be first and whose will be second. As an upper tier, you always want your sub's policy to be exhausted before your policy is exhausted, and that's what that states. Okay, waiver of subrogation, and again, a lot of times these are done on a blanket basis, which means it's subject to the written contract or agreement, so you have to have that in place. You can get a waiver of subrogation on general liability. You can get a waiver of subro on and additional insured on general liability, auto liability, and umbrella, and you can also get a waiver of subrogation in most states on workers' comp, but you cannot get additional insured on workers' comp. And what this does is this effectively waives the rights of the insurance company, agrees to waive their rights to subrogate or come back after the upper tier in the event that they claim that there's some degree of negligence. And in some states like Utah, even though they have that anti-indemnification language relative to the lower tier having to have at least some degree of negligence, in Utah, for example, they don't require that or obligate that when it comes to the insurance piece. So maybe the lower tier has to have negligence from the indemnification clause, but if the insurance company is covering the upper tier as an additional insured and a waiver of subrogation applies, even if the upper tier has sole negligence, they might be able to have the lower tier's insurance company protect them. Okay, here's an example of certificate of insurance. This is a subcontractor who provided this to an upper tier contractor that we were working with. We gave them sample language to put all the right endorsements and the certificate of insurance, but when we got the actual endorsement, the endorsement says any person or organization for whom you are performing operations are additional insured when you and such organization have agreed in a contractor agreement, which in this case they had, they'd be added as an additional insured. However, such person or organization is additional insured only with respect to liability or covered bodily injury, property damage, personal advertising injury caused in whole or in part by your acts. So in this case, this additional insured version was not very broad because the subcontractor had to have at least a percentage of negligence. There are other versions of the additional insured where the upper tier contractor can be solely negligent and still be covered by the subcontractor's policy. Now you may or may not agree with that philosophically, but it does exist. And then it went on to say a person or organization that status as an additional insured under this endorsement ends when your operations for that additional insured that are within the scope of the contractor agreement are completed. Well, that's an ongoing operations additional insured form, not a completed operations. And on this certificate that the insurance agent signed, they stated that the lower tier was providing both ongoing and completed operations additional insured status, and in reality they were not. Now this happens all the time. So as the upper tier, you need to be aware of this and monitor this, because even if you've asked for it to be on the certificate, now you may say, well, if it's on the certificate, then the agent should be liable for that because that's something that they listed on the certificate of insurance. Well, let me just show you something. Here's an example of a certificate of insurance. Notice the language at the top. This certificate is issued as a matter of information only and confers no rights upon the certificate holder. The certificate does not affirmatively or negatively amend, extend, alter, or the coverage afforded by the policies below. This certificate of insurance does not constitute a contract. Now, the reason why they say that is because, you remember in the additional insured endorsement it said there has to be a contract. Well, they're specifically stating that a certificate of insurance is not a contract between the issuing insurer, that's the insurance company, the authorized representative, that's the insurance agent, and the certificate holder. Important. If the certificate holder is an additional insured, the policies must be endorsed. If subrogation is waived, subject to the terms and conditions of the policy, certain policies may require an endorsement. A statement on this certificate does not confer rights to the certificate holder in lieu of such endorsements. So that's a problem. Basically, that's the disclaimer language that takes out a lot of the value of the certificate of insurance. Now, you still have to get them, as I mentioned before, but there's a lot of value taken out. Now, there's other issues relating to certificates. For example, you may have seen on a certificate that the limit of insurance is $2 million aggregate limit. Okay? Now over here, you'll see the aggregate limit applies on a policy basis. That's not good for the upper tier. It's not good for the lower tier either. That means that basically, if that $2 million is used up because of claims, there's no more coverage, and the policy is a 12-month policy. It runs from this term to this term, versus having that aggregate limit on a per project basis, meaning every project that subcontractor works on for any GC that they're working for or owner has a $2 million limit per project. That's what you want to have as a sub. That's what you want to require your sub to have if you're the general, because if you're the general and you get a certificate of insurance and it shows you a $2 million limit, you might want to notice this little disclaimer that says limits shown may have been reduced by paid claims. So it may show you a $2 million limit on the certificate. There may have been some paid losses that brought that down to 0. So it says $2 million, but because of this disclaimer, they really could have 0 because you'd never know what claims they've had. So what's the value of an insurance certificate? They can be easily fraudulent, so I would never get a certificate directly from the subcontractor. I'm not saying all subs do this, but I have seen cases where the subcontractor has changed the date on the certificate of insurance, and they didn't really actually have coverage. It does not disclose exclusions. Could cancel the very next day, the very next month, week after receipt, and you would never, in most cases, you would never know about it unless you obligated the subcontractor to insurance company to provide you a 30-day notice of cancellation, which is another endorsement that there's generally a charge for. Additional insured, primary non-contributory waiver, subrogation can be listed on the certificate but may not be valid without the appropriate endorsement. Limits shown may have been reduced by paid claims, as I mentioned. Additional insured status indicated on the certificate may only be for ongoing ops, not completed ops. Additional insured primary non-contrib waiver sub may not be valid without properly written and executed subcontractor agreement, meaning they're on a blanket or automatic basis, but it's still required even though it provides you very basic information. So here's the next category, construction defect litigation. Question is, what is the greatest tool to have the lower tier subcontractors insurance defend the upper tier contractor? The answer is the broadest additional insured endorsement that includes both ongoing and completed operations. So let's go through the recap. So we've got a certificate of insurance. Everyone's got to get that. It's very basic. Legal action against a subcontractor may cost money. So what I didn't say is when you're additionally insured, you don't want to have to sue the insurance company of the subcontractor in order to get them to protect you as the upper tier. If you've done things properly, it should be automatic. It should happen automatically. And so these are the steps that I'm trying to teach you so that things can happen automatically without you having to actually sue the insurance company, which is costly, time-consuming, just a headache for everyone involved, creates a lot of heartache and pain. Nobody wants to be involved in litigation. Additional insured, ongoing operations, the 2013 version, if that's all you can get for both ongoing and completed ops, get it, but that's not the best version. An earlier version typically is going to be broader. Having a hold harmless indemnification agreement signed prior to the work starting, very, very important. State specific, by the way. You want to make sure they have additional insured. So this is the additional insured for ongoing and completed ops. An older version that's going to be broader to the upper tier contractor. And remember, you want this on the liability, the auto, and the umbrella, and then a waiver, subrogation. And on all of these, you want the policy to be primary non-contributory. Waiver, subrogation, you can have on all 4 policies, GL, auto, work comp, and umbrella. You really want to have, if you can, that the hold harmless indemnification be an insured contract so that the subcontractor does have that third-party action over coverage in their general liability policy. And finally, you can do all of this stuff right, and it's still not matter because the sub's insurance may exclude the scope of work that they're actually performing. So that's a pretty important one. That's why it's at the top. This is pretty critical that you find out if your sub is actually covered for their scope of work, and that can be difficult to do. So, talk about a solution to how to kind of manage this process.
Next, I want to share with you the solution that I talked to you about earlier in helping to manage the certificate of insurance process and uncover hidden exclusions with your subcontractors. Let's look at the old-fashioned way of doing certificates of insurance and coverage verification. You have the requester, who hires a subcontractor or submitter. The submitter has their own insurance agent and who provides a certificate of insurance. They build a project together, the requester and the submitter, the GC and the sub, let's say, and that project fails over, let's say, a 6 or 7 year period of time. The general contractor has his insurance company, who has their team of attorneys that may spend a lot of time in the discovery process. Well, in some cases, the subcontractor may be out of business. The upper tier or general contractor may not have done a great job at record retention, and so they may not have who the insurers are over that time period, and they may or may not have had a subcontract agreement in place. Now, even with all of that, the subcontractor may or may not have a residential exclusion in their insurance policy. So this goes to court, and there's a settlement awarded, and in this case, it would be the insurance company of the requester and or the requester, depending upon circumstances, who would be obligated to pay that settlement. The GotMySuite Way is a better way. It is a cloud-based system where the requester can input all of the requirements of the submitter. The submitter then can add their insurance agent into the system via email. The insurance agent through that email is also able to click on a link and add the certificate, the supporting endorsements, and is asked to disclose any of the prohibited exclusions of the requester that are contained in the submitter's insurance policy. The insurance company for the requester, or the GC underwriter, is able to have access to this information, as does the loss control. Also, with GotMyContracts, the requester is able to push to their submitter, or the GC to their sub, risk transfer agreements for electronic signature and storage, which the system also allows the insurance company to have access to. The auditor loves the system from the insurance company, and it simplifies the process for the requester in his audit because the auditor can be granted access to all of this information. And it allows the insurance company and their attorneys to have access to this information so that they can go back for years and determine who are the different insurance companies that were on that loss from that subcontractor. And the requester may want to have a super broker have access to the system, their insurance agent, so that they can assist the requester in managing the process.